Hey everyone, it's Kirk here again at OptionAlpha.com, and in this video we're going to go through the differences between buying options and selling options. Now, as a quick review, there are only two types of options contracts out there, calls and puts, and everything you can do in this space revolves around these two types of contracts. Now, until now, in our track one here for beginners, we've only really talked about options buying, not really talked about selling. We've mentioned that there's an option seller, but it's kind of been like this person who's on the other side of the trade. We haven't really talked about how they can actually build a position and a core position selling options versus buying, and how that can be the basis for trading for income. So let's start with this kind of table here, because I think it goes through a little bit of the rights and responsibilities that we need to be aware of as traders when it comes to buying or selling calls and puts. Now remember, there's two sides to every trade. So you always have a buyer, you always have a seller, and then we can only ever trade calls and puts. So there's really four types of basic options that we can get into. We can buy calls and puts, or we can sell calls and puts. In this case, the option buyer for a call option has the right to buy stock at a certain price in the future. Now again, if you are an option buyer, you are generally outlaying money in premium. So when you pay for something, you get back a right for making a choice in the future. You're paying for that choice. So again, as an option buyer, they have the right to buy stock at a certain price in the future. Option buyers might buy a call option on a 50 strike stock and say they want to buy that stock for $50 a share at any time in the future between now and expiration. On the other hand, a put option buyer has the right to sell stock at a certain price in the future. So again, they're still paying money to the option seller, so they still get a right, just like the call option buyer. But now instead of wanting to buy stock, they want to have a guaranteed sell price at where they're going to sell that stock in the future. Okay, so they might want to sell stock at $50 and hope that the stock is trading for $30 and they can buy it in the open market for $30 and resell it for $50. Okay, so again, the key here with option buyers is they pay money. They have to outlay the money, the cash, the capital, and for doing that, they receive a right back from the option seller, or a choice back from the option seller. Now, on the other side of the table here, we have the option sellers. Now, the option sellers now have the obligation, because they gave up their right to the option buyer. Now they have the obligation to sell stock at a certain price in the future. But here's the key: only if it's expiration or they are assigned. Okay, so this is the key. It's not like this can happen at any point and you give up. Well, it can happen at any point, but you don't give up your right to do something with the actual options contract, because you can close out of the options contract and sell your contract to somebody else or buy back your obligation. You can do a lot of things. So the obligation to sell stock only happens at expiration or if they're assigned early in the process. Now, we have more videos about the assignment process here in the first track and module here at Option Alpha. And really, most of these assignments happen the last week of expiration, even the last few days. So I don't want you to get totally like your feathers ruffled that this is going to happen immediately when you get into a contract. It does happen the last week, usually the last couple of days. But again, the key here is that as an option seller, you have an obligation to sell stock. If you agree with an option buyer that they're going to buy stock from you at $50, you're going to sell it to them at $50, you have to sell it to them at $50 if that contract actually comes all the way through expiration. On the put side, it's the same thing. You have an obligation now as the option seller of that put option. You have the obligation to buy stock from that option buyer who's going to sell it to you at whatever the predetermined price is. So if that option buyer, that put option buyer, says that they're going to sell you stock at $50, then you have the obligation to buy stock at $50. Your hope as the option seller is that the stock is worth more, because now you're going to buy stock at $50 and then resell it in the open market for some higher price. But again, the key here is that the seller is now collecting money from the option buyer. So money goes from the option buyer to the option seller, and then the right gets transferred from option seller to option buyer. So that's the cycle, that's the process. And again, it works on both calls and puts. Now, we also built this little graphic here, which I think is really cool. This kind of like four-part graphic that shows you kind of what your expectation is for the actual underlying stock, whatever you're doing, okay? in this case, if you are, and let's just kind of go through all these different examples, if you are a call option buyer in this case, then you are hoping that the stock price rises. That's your hope. You're buying a call option in anticipation that the stock price is expected to rise in the future. If you are a put option buyer, then your hope is that the stock price actually falls. So you want to see the stock price fall below your strike price that you entered into. As a call or put seller on either side, and this is where we start to really distinguish the difference in this non-directional trading. As a call or put option seller, remember that you are taking in a premium, and really the onus or the need for that option or that stock to move for you to lose that premium is really on the option buyer. So by taking in that premium, you also get the additional benefit because you gave up your rights for the stock to actually move sideways and still make money. So in both the case of a call and put, if the option were to move sideways, meaning to trade range bound or just move sideways and not really trade higher or lower, then you would actually still make some money. Now you do want, as a call seller, you want the stock price to fall. Remember, option buyers on the call side want the stock price to rise. You want the stock price to fall. As a put seller, you want the stock price to go up or generally stay sideways. And again, we'll continue to go through many, many more examples, but hopefully this is a really good graphic that you can use. Print this out, put it by your desk, and use it as you start to learn and develop a little bit more trading skill with whether you want to be an option buyer or seller, calls or puts. This is a really cool graphic that we made for you. All right, so now let's review the differences between credits, debits, and opening and closing when trading options, because now we're starting to get a couple more choices or options, no pun intended, on how you can build different strategies, and it's important to know how money's transferred and how the order types go through, okay? All right, so here's the deal. Now, it doesn't matter in this case whether you are doing or using this for calls or put options because they work both the same way. And it really depends on if you're going to be long options or short options, meaning if you're going to be buyers, in this case, buyers, long, and sellers, which is short, okay? Now let's go through some examples here and we'll use another graphic. This is a great little resource that you can print out and put by your desk as well. But if you are, let's say, long, meaning buying, and you want to buy to open, because that's usually how you start the option buying process. You have to buy to open a new position, and that's really the key here is buy to open. Sometimes you'll see broker platforms will put in here BTC, which is BTO, and we'll do BTC in a second, but BTO, which is buy to open. Again, if you're going to buy to open something, you're going to outlay money, and that is called a debit. So this means that you are paying money to the option seller to open a new position, okay? Now, when you go back and you want to reverse that trade, because again, you have a choice to reverse that trade anytime between now and expiration. You don't have to hold on to that trade all the way through expiration. You can go back and remove your position and kind of sell out of the position if you want to. Now, you're still long the position initially, but now you're going to go in and you're going to enter a sell to close order. And again, your broker might show this as STC, an STC order, which is sell to close. Don't get confused by the terminology and all the acronyms. You understand exactly what it means, and it's just logical progression and thought process that we want to follow. So we already have a long option. We want to go back in and exit the trade. We want to use a sell to close order. And when we do sell that option back to the market, we're going to hope that we collect a credit for doing so. I mean, we're going to collect a credit. We just hope we collect more than the debit. So in this case, if we paid a debit of, let's say, $5, we just bought an option for $5, we hope that we collect a credit when we sell it back of $7. Now we've realized a $2 profit on our trade beginning to end. We bought to open, then we sold to close. We paid $5, then we received $7 at the end. We ended up with a net profit of $2 at the end of the day. Okay, just using basic numbers. Now, on the other side, if you're going to be an option seller first, meaning you're going to enter a short position, whether you're shorting calls or shorting puts, you're going to enter that first order as sell to open. So this is a little bit different. This is where some people get a little confused, but again, just follow me on this. An STO order, okay? Some brokers might show that, some other brokers might not, but you're going to sell to open a new position. Now, this is going to be the other position that someone else bought on the top side. So an option buyer would buy open, and they would be opening a position with an option seller who is at the same time opening a new position. So two people are opening a brand new position on either side of the market. In this case, you're going to take in a credit. Now remember, the debit that the option buyer paid was $5. So you're going to take in that $5 credit, in this case with that option buyer. Now later on, if you decide to close out of your position, again, you're hoping that you can make at least $5 on the trade, maybe something a little bit less, but that's the maximum amount you can make. You can't make more than the credit that you received on the trade. So you're going to hope that you go back in. Again, you still have a short position, and you're going to buy to close out of your contract. So again, this is on some broker platforms going to be a BTC, buy to close. So you're going to buy to close, and you're going to pay a debit. Now you're going to hope that you collect, let's say, a $5 debit from that option buyer, and somewhere else down the line, you buy back your contract and close out of the position. And let's say it only costs you $3 to buy out of the position. Now you are left with a net profit of $2. Okay, so now you can see that option sellers, or those who are going short, no matter if you have calls or puts, want the future value of those options to be less, because if the future value of those options is less than the credit that they initially received, that creates an opportunity to profit. Okay, with option buyers, you want to buy options at 5, sell them at 7. With option selling, you want to buy something, say, at 5 and sell them at 3, or sell them at 5 and buy them at 3, sell them at 7 and buy them at 5, whatever the case is. Okay, so hopefully that makes a lot of sense. But again, it's all about these credits and debits. Debits you pay out, that's money out of your pocket. Credit, that's money that you receive. You get credit to your account. Okay, so again, if we have option buyers, just to use a little bit more and kind of drill this in if you need it. If not, you can skip through this part of the video. But if you are an option buyer and this is your contract, this is your option contract that you have, if you're going to buy an option, you're going to give up some of that cash in exchange for getting that contract. So now you have the contract as an options buyer, but you had to give up some of your cash to the option seller. So you paid a debit to get into this trade. The option seller received a credit. Okay, if they want to reverse the trade, now if you're an option buyer and you want to close out of the position, you have got to go out into the open market, take your contract and sell it to somebody else. Okay, that option seller or new buyer in this case might then pay you your money back. Okay, so now you're getting a credit back, and this seller, if they're a new buyer, they don't already have an existing position, they're going to pay you some money, a debit, and you're going to receive your credit back. Okay, so it's all this interaction between buyers and sellers surrounded by this options contract that we have. All right, so finally, let's quickly talk about trading cash versus on or with margin, because this is a big topic, and I want to make sure that we cover this and talk through a little bit as much as we can here on this video tutorial. Now here's the main difference between them. I want to make sure you get the main difference, because there's so many little innuendos between different brokers, and I don't want to pick one broker and say that that's the way that they calculate margin or how they do it, because it is literally different between this broker and that broker and your account and somebody else's account, even within the same broker. There's basic guidelines that most brokers follow, but you'll want to check with them and know exactly how they calculate things. And you'll start to see this as we go through some live trading examples here at Option Alpha as part of these tracks. Now, the first thing that you can do is you can trade on cash. Now, as the name suggests, you have to have the cash to back the trade. This is usually required on net long options, and cash is usually required in IRA and retirement accounts. IRA and retirement accounts have a little bit more of a stricter policy on the type of risk that you can take, meaning you can't trade naked options or undefined risk trades in a retirement account, because mainly you can't trade on margin in those accounts. So with cash, if you're going to go out and you're going to buy an option contract and the option contract is $100, then you have to pay the $100 to get into that option contract. Same thing in an IRA account. If the option contract is $100, you got to have the cash to back it up as far as a $100 trade. If you go out and you say, and you enter a, let's say, credit spread or type of a spread, which we'll talk about here later on, and let's say the risk in that trade is $500, okay, and I'm just using round numbers, then you have to have $500 to back up the maximum potential risk in that trade. Again, if the maximum risk in a particular trade, whether it's a regular long option or a credit spread or something else, if the maximum risk is $500, you've got to have the cash in your account to cover that risk, okay? And same thing goes with an IRA. If the maximum risk is $500, you better have $500 in your account to cover that trade, or you won't be able to place the order. You won't actually be even at a point where the broker allows the order to go into the open market to be placed. Now, this is different than trading on margin. Margin is when you borrow or you have less money put up than the maximum amount of risk in the trade. This is why we talk a lot about here at Option Alpha about keeping your position size small, keeping your overall allocation small, because margin can expand, and we have done podcasts and video tutorials on that, which you can definitely check out. But margin is basically borrowing money or trading with a little bit of help from the broker, okay? In this case, it usually happens more often on net short positions. So if we are a call seller or a put seller, we might have to enter that contract, and we might have to put up what's called margin. So we put up some portion of the maximum amount of risk on the trade to cover this. Now, this usually does not occur in any IRA or retirement account. So just forewarning, you have to usually have cash backing it, or the cash value of the maximum risk in IRA accounts. But let's go through a quick example here. So let's say that we are an option seller and we collect a $100 premium buying an option or selling an option from an option buyer. Okay, that option buyer might pay cash for that. We collect that $100 of cash. But now that we're an option seller, let's say the maximum risk on the trade is $1,000, meaning at the worst possible point, we could lose $1,000 on the trade. Well, if we are trading in a margin account, or we have a higher trading level approval, we can then go out and the broker can help us and say, you know what, we're not going to require that you have $1,000 in your account initially to enter this position. We might only require that you have, let's say, $700 in your account, okay? So now we're trading on margin, meaning the broker is not going to require us to carry the full risk in the trade initially. But don't get confused here, because if the trade starts to go against you, you still can lose the maximum amount for that particular trade. Now, I'll show you later on in video tutorials how we figure out what that amount is, but you can still lose that maximum amount. So don't assume that what the broker carries, an initial margin requirement, is going to cover all of your risk in the trade. Okay, now this is again mostly with net short option positions, not net long option positions. But this is helpful because as you trade on margin, now you could potentially make $100 on $700 of your account being margined, or a much better return than, say, making $100 on $1,000 of your account being margined. Okay, so it's a little bit more of that added leverage potential that your broker is going to look at. Now, another thing that most brokers look at is what's called portfolio margin. As you get into higher trading levels and higher account approval levels, they'll start to offset different positions. So if you have, let's say, a position in oil and you have a position in, say, let's say gold, they might look at those positions and say, you know what, your position in oil, offsets some of the risk that you have in gold. So for both positions, we're going to keep dramatically less money in margin, or we're not going to hold as much money because they're not really, they're uncorrelated and they don't really have an impact on each other. So there's a lot of different things that happen with margin accounts. And again, I want to kind of go through some of the basics here so you guys understand how cash versus margin accounts work.